Great. So thank you first for the invitation. I'm happy to be here. This is joint work with Amit Chowdhury at Polygon and my colleague Raman at Warwick. Okay, so essentially, I will talk about decentralized lending protocols. So many of you may be familiar with decentralized exchanges like Uniswap, but lending protocols essentially offer these sort of intermediation services where essentially you can have both lending and borrowing of different assets. In what happens is that instead of a credit score, anyone who wants to borrow a currency, they have to essentially provide collateral. So effectively, you replace the traditional finance of credit scores with over-collateralized borrowing. So the way that they do this is through smart contracts. So essentially, smart contracts are kind of code that enforces sort of how much you can borrow, sort of how much collateral you have to deposit, and essentially there are a bunch of other parameters of the protocol like interest rate rules, and that are essentially voted on by users of the protocol. So essentially users can stake governance tokens to vote on interest rate rules and other parameters. Okay, so the questions that we will ask in this paper are what are determinants of interest rates on these protocols? And so essentially we have this finding that interest rates on stablecoins are typically higher than interest rates on riskier cryptocurrencies. So we want to understand what are the determinants of these interest rates. Are there sort of integration between lending protocols and futures markets? So essentially, we hypothesize that these lending protocols are essentially a way to do leverage trading. And so if that is the case, there should be some integration between lending protocols and futures markets. We'll also look at arbitrage between lending protocols and futures markets. So in traditional currency markets, we have these arbitrage conditions like covered interest rate parity. So we can test if these arbitrage conditions hold in cryptocurrency markets as well. Okay, so we first look at the interest rate difference between stablecoins and risky currencies, and we find that they do reflect the speculative beliefs of investors. We will show that lending protocols and futures markets are integrated, but only weakly. And we will show that potential reasons why there's weak integration between lending protocols and futures markets is that arbitrage may be limited because of transaction costs, and there's some segmentation between the markets. So essentially, investors can have different beliefs in lending protocols versus futures markets. So if there's some segmentation, that can explain why integration is weak. Okay, so there are two facts that motivate our research questions. The first is that interest rates are typically higher for stable coins than risky cryptocurrencies, right? So essentially, there is a cross-sectional difference between stablecoin interest rates and risky crypto rates. We also show that there is some correlation between interest rates and futures premia, and so that is evidence that there is some integration between lending protocols and futures markets. Okay, so this is essentially the first fact. So we find that stablecoins like Tether, DAI, and USDC typically have much higher rates on these protocols than risky cryptocurrencies like ETH, WBTC, and ZRX, right? So essentially, the stablecoin rates are higher. There has been some reversal over the last year, and that is in line with a bear market where essentially we start seeing stablecoin rates going below risky cryptocurrency rates. So essentially, the interest rate differential is going to be a function of the speculative beliefs of traders. Then the second fact is this relationship between interest rates and the futures premium. So we will use, for the analysis in this paper, the perpetual futures. So in addition to the futures premium, there's also a funding rate, which is essentially a rate paid by long position holders to short position holders every 8 hours, right? So essentially, we find that there's this positive relationship between the interest rate difference and the futures premium. So this suggests that there's some integration between the lending protocol and the futures market. Okay, so why should there be integration? We argue that you can use a lending protocol to make long or short leverage positions. So a long leverage position is an investor that deposits ETH as collateral and borrows DAI, and they can essentially leverage their position on ETH by selling DAI for more ETH in the secondary market. And then once the ETH prices increase, they buy back DAI and then repay the debt. So essentially, the long leverage position is what you would do if you are bullish about the price of ETH. Conversely, if you are bearish about the price of ETH, you'll do a short leverage position. And this is very much like short selling in kind of traditional sort of equities as well. So here you would deposit a stable coin and use that as collateral to borrow ETH. You would then sell ETH for the stable coin in the secondary market. And then once the ETH price has dropped, you will buy back ETH cheaply to make a profit, right? So it's very similar to kind of short selling a stock. And so because you can do long and short leverage positions, this will in turn determine the demand for borrowing stable coins and risky cryptocurrencies, and the relative demands for borrowing stable coins versus risky cryptocurrencies determines the interest rates. So in terms of the data we use, we have essentially compound data. So the two main protocols out there are Aave and Compound. So we use data from Compound. So we use the Compound API to get borrowing, lending rates, as well as the aggregate amounts borrowed and lent in each currency. We also have a sort of transaction level data from Kaiko, and essentially this allows us to trace for individual wallets the amounts they deposit and borrow of respective currencies. So in terms of our futures data, we use perpetual futures for the ETH tether pair, and we essentially have this additional parameter called the funding rate. So essentially perpetual futures, they don't actually have an expiry, but they do have this funding interval of 8 hours. And essentially this funding rate is a transfer from long position to short position holders every 8 hours, right? So essentially we can use this 8-hour interval as kind of a natural sort of time horizon in our analysis. So other things in terms of lending protocols I wanted to cover is sort of how interest rates are determined. So interest rates on Compound follow these linear rules where the interest rate is a function of utilization, and utilization is essentially a measure of the fraction of a currency that is borrowed. So for example, if you have 100 DAI in the supply of the protocol and 80 of the 100 DAI is borrowed, then that's a utilization of 0.8. So essentially these interest rates are going to be a linear function of utilization on Compound, and these parameters are set by the governance, by governance votes. And so there's going to be a link. So the higher the fraction of the currency that's borrowed, the higher the interest rate. So when we look at the historical data, we find that the borrowing rate is a linear function of the utilization rate. And we also note that for some of the stable coins, there is a kink here as well. So there's an interesting feature that if the utilization starts getting very high, then the interest rates start increasing much more. So there's kind of essentially a convexity with the interest rate rules. Okay, so to motivate our empirical results, we have a model where we think about the integration between the lending protocol and futures markets. So essentially, we have two coins, a stable coin and a risky cryptocurrency. And then we have essentially these investors that are doing long and short leverage positions in the market, right? So here is where we essentially argue that these lending protocols are being used to either take a long leverage position in ETH if you're an optimist, or a short leverage position if you're a pessimist, right? And so when you have these two sets of investors, they both have either bullish beliefs about ETH or bearish beliefs about ETH. You will then get a relationship between the interest rate difference between the stable coin and the risky cryptocurrency, and then the average speculative beliefs of the investors. So this P bar is essentially an aggregation of the optimist and pessimist beliefs. So if there are essentially, if the optimistic beliefs go up, so if P bar go up because there's a kind of an increase in the optimist, then that will put upward pressure on the interest rate differential. Then we also have essentially a risk premium term here to account for wealth of optimists. So if we look at the futures market, so you could also do long or short positions in the futures market, right? So here you're going to get a futures rate that is also a function of the optimistic and pessimistic beliefs of investors. But we allow for the fact that there could be segmentation between markets, right? So in other words, the optimists and pessimists in the futures market can be different to the optimists and pessimists of the lending protocol. So we do allow for the fact that the beliefs of investors on futures could be correlated with the beliefs of investors on the lending protocol. And so if these beliefs are perfectly correlated, we have perfect market integration. However, if the investors are fundamentally different beliefs on futures market versus the lending protocol, then we would have the second case where there's zero correlation between beliefs, and then there'd be sort of market segmentation. Okay, so if there's essentially a big discrepancy between the interest rates in the lending protocol and the futures rates in futures markets, arbitrageurs should step in to essentially align the two markets. So in other words, like we should have some essentially arbitrage trading going on if there's a big discrepancy between the two markets. So for example, if in strategy one, if futures rates are priced too low relative to interest rates, then you could enter a long futures contract, and then you can deposit a stable coin and borrow the risky asset. And this trading strategy should essentially help align the interest rate difference in the futures premium. Alternatively, if the futures premia are too high, then you can enter an arbitrage trade where you short the futures and then you buy the risky asset and deposit into the DeFi protocol. And so this sort of arbitrage trade will be beneficial if futures premia are overpriced. So this leads to these arbitrage bounds where if the futures premium essentially has to lie between these sort of interest rate differentials in the lending protocol. So if the futures premia lie outside these bounds, then you can conduct arbitrage. So in terms of our testable hypotheses, if we have unlimited arbitrage, we should get a very traditional kind of interest rate parity relation between the interest rate difference and the futures premium. Alternatively, if arbitrage is limited, then if only speculators are trading, then we will also get integration between the lending protocol and the futures market, but not with unity. So we have essentially this parameter of half, and then we also have a risk premium as well. The third hypothesis is that if arbitrage is limited and there's segmentation, then segmented markets is going to attenuate the relationship between the interest rates and the futures premium, right? So to the extent that beliefs of investors are different on the lending protocol and futures markets, then that's going to attenuate the relationship between the lending protocol and the futures market. So now to the empirical evidence. So the first thing we are doing here is testing if there is long and short leverage positions happening in the market, right? So here, using kind of the transaction level data, we classify a long leverage position as depositing ETH as collateral and borrowing Tether, and a short leverage position is depositing Tether as collateral and borrowing ETH, right? So essentially, these are how we classify long and short positions. And we find that for most of the sample, we have essentially net long positions, right? So there are more people taking long leverage positions than short leverage positions. But later on in the sample, in kind of the bear market, we start seeing more short leverage positions. And we find very similar patterns when we look at USDC and DAI as well. So this is not just Tether specific, but it's more of a general pattern that we see with other ETH stablecoin pairs. So what we can show here is some evidence of integration between the markets. So here we define the long-short position as essentially the net of long-short positions, and that correlates positively with our futures premium. And if we separate it into long and short positions, so long positions are positively related to the futures premium, and short positions are negatively related to the futures premium. Okay, so that's evidence that these long and short leverage traders are sort of in line with long and short trading in the futures market. The second piece of empirical evidence is looking at determinants of interest rates. So here we are looking at the interest rate difference between Tether and ETH, and then we are testing for whether it correlates with the futures premium and other controls. Now, as we can see here, it does correlate positively with the futures premium. One thing I would like to note is that the coefficients are very small. So here we are going to look at an 8-hour period because the funding rate is, as I mentioned, is calculated every 8 hours. And we find that the interest rates are correlated with the futures premium, but not a coefficient of 1. It's actually much smaller than 1. And so this is basically showing that there is integration, but economically it's weak, right? So if we expected sort of full integration, it should be 1, but in fact, it's much less. So that suggests that there is weak integration between these markets. So in terms of explaining why there's weak integration, one idea is that it could be transaction costs, right? So here, many of you know to do these transactions in the Ethereum blockchain, you need to essentially pay gas fees. And so if we take into account gas fees, we find that our CIP deviations are essentially within gas fees. So you can think of these CIP deviations as essentially arbitrage opportunities. And so these arbitrage opportunities are typically small once you account for gas fees, right? So essentially a lot of the sort of inactivity or inactive arbitrage trading, one reason is that it's quite expensive to do so. The second reason we have for why integration is not very strong is that there's segmented markets. So by segmentation, I mean that the beliefs of futures traders are different to the beliefs of traders on the lending protocol. So here we do kind of a very traditional test in FX, which is looking at kind of your future spot returns in the currency market. So this R is essentially ETH Tether returns. And we find that it does correlate with the funding rate, it doesn't correlate with the futures premium, and it also is not significantly correlated with the interest rate difference. So here we're essentially saying that, look, the traders aren't able to have sort of aligned beliefs in the markets when it comes to actually predicting future returns. So in some sense, there is segmentation between the two markets when looking at investor beliefs about the future rate. Okay, so to conclude, we looked at the determinants of interest rates on lending protocols. We showed that there is integration between the markets, so this relationship between the futures premium and interest rates. CIP deviations are generally due to limits to arbitrage, so there's essentially difficult to execute arbitrage when you have high transaction costs. And the return predictability is low, so that means that there's segmentation in the market. So futures and traders and lending protocol traders have different beliefs. So this suggests that there could be some potential misallocation or market inefficiencies. To explain why the lending protocols are not more integrated. And so potentially some improvements in the market in terms of, say, lowering transaction costs could potentially improve the integration between markets. Thank you.
All right. So thanks a lot to the organizer for giving me the opportunity to discuss this very interesting paper. So I'm going to do two things. I'm going to summarize the paper and have a couple of comments. So the research question of the paper is really trying to explain the interest rates pricing of this new DeFi lending protocol, things like Aave or Compound. And in particular, the paper is really focused on these interest rate parities and whether this holds and under which conditions. The paper we start with like this stylized model, which has a couple of elements to try to summarize on the slide. So the model has three agents. We have on one side some optimistic agents. On the other side, we have some pessimists. And then we also have futures market arbitrageurs. It might be different agents with different set of preferences as well. So we have two assets. We have one risky crypto asset, so think about something like Ethereum or Bitcoin. And then you also have one stablecoin, which is a safe asset in this environment. Then we also have this derivative market where agents can trade futures contracts based on the price of the risky asset. And then what happens in the model is that the DeFi lending platform allows for the pessimists to take a short position, whereas the optimists will want to take long leverage positions. And the balance between the two is going to determine the equilibrium interest rates and how these things are moving. So I tried to summarize what I think is the main intuition of the model, like with just a couple of graphical representations. So I think we really have like two markets. We have one market for borrowing DAI, the stablecoin, and one market for borrowing Ethereum. And so I'm just starting from like what would be the normal, like the most basic economic graph of supply and demand. And then if you have that, you have demand. That's here. Remember, it's driven by the optimists that want to borrow DAI in order to take some leverage. And then on the other side, you have the supply. Here it's coming from the pessimists that are willing to lend the stablecoin. And so you have demand and supply. So you have an equilibrium. You have a price and quantities that's determined. Same thing for the Ethereum lending market, except that now on the demand side, you're going to have the pessimists. And then on the supply side, you're going to have the optimists. Okay, there is a little bit of a trick because now everything happens in the DeFi lending platform. It means that the whole pricing is mitigated by this PLF, or like this function. Interest rate is a function of utilization rates. So that's going to generate some inefficiency in the markets, which here is represented by the supply curve that the supply is actually facing, and the supply curve that the demand is facing is going to be at a wedge. in order to represent this inefficiency from the trading platform. So what's going on in particular is that the rate at which, in equilibrium, the rate at which you borrow is going to be different to the rate at which you lend. And so that's going to generate some utilization gap, because you're going to have more supply in the platform than you're going to have utilization or demand. And then we have the same thing in both platforms, because both platforms are mediated by this DeFi lending. Then what happens is that you can have a shock. We can do some comparative statics and imagine what would happen if you have a change in the optimism or the wealth of the optimists. Let's say now optimists become less optimists. So what happens is that now the interest rates, both the borrowing interest rate and the lending rate on DAI will have to decrease. And then we can also do what happens when the pessimist becomes more pessimist. Then now on the Ethereum lending markets, there is going to be an increase in the demand in this case. All right. Okay. So the model really has I think 5 main predictions. So the 5 predictions are that if you have this increase in optimist wealth or this decrease in pessimist wealth or just pessimism in general, then you're going to end up like an increase in the spot risky cryptocurrency price. You're going to end up with an increase in the future cryptocurrency price as well, if markets are somewhat integrated. At the same time, you're going to have an increase in the stablecoin lending rate, and you're going to have a decrease in the risky asset lending rate. And then there's also like this condition that CIP should hold within the bound of arbitrage. So here is coming from 2 possible frictions. One friction is just the discrepancy between the borrowing and the lending rate. That's going to create like some regions where the arbitrage is not feasible, because the rate at which you borrow is not the same rate at which the one which you lend. And on top of that, you might have to incur some additional fees or gas fees, which is going to increase the cost of doing the arbitrage. These are the 2 frictions. But within these bounds, CIP should hold. Okay, so then the paper goes on and tests the result empirically and actually finds that all of the interest rate patterns that is predicted by the model are actually verified. And in terms of parities, we find that CIP actually holds within the bound. That's this very nice graph that Ganesh showed us earlier, where you can see the bounds, the limit, and you see that CIP is always within the bound. And then the paper also tests UIP, and UIP is a bit more mixed. UIP doesn't really hold. Seems to be there is like some lack of rationality in terms of like forecasting the path of future interest rates. Okay, so I will start with my comments, and I have really one main comment, which is that I think in the modeling part of the paper, it's a little bit sometimes a bit unclear which result depends on which specific assumption. So the model is very rich, and it has very realistic component, which is a good thing. But then it's sometimes a bit difficult to understand what's going on within the model. So the model has like this optimistic, pessimistic agent. You have the utilization rate curve, this PLF function. You have also on top of that, you have a reserves buffer. You have some internal borrowing rate in the perpetual futures. And it was a bit unclear for me exactly what was in practice, but that's just a side comment. I think people could be a bit clear on that side. You have transaction costs, you have arbitrageurs, you have segmentation. So you have like many different elements, and I think people would benefit from like clarifying exactly what's driving what. I think one easy way of doing that is just basically starting from a simpler model and then like building up the complexity one by one and then getting a little bit more intuition about what's going on. So that's also what I'm going to try to do here. So I think, in other words, the paper lacks a little bit of a benchmark, which we can compare the results. That's my sense. So when I was trying to understand what's going on, I went back to what's my benchmark model. My benchmark model is something like consumption CAPM. Like I think at the end of the day, it's a general equilibrium model, so it's an asset pricing model. I went back to something that looks like the general equilibrium version of the CAPM. So just in mind, this is a toy model, an alternative toy model I have in mind. So you have infinitely lived representative agents. They all have log utility and they have a discount rate rule. And then if that's the case, there is 2 assets. There is one risky asset and one riskless asset. And then the whole model is very, very simple. You just have the price of the crypto asset. The risky crypto asset is just going to be some form of fundamental value. You can think about it as being cash flow or whatever can be also like just the expectation of what the price is going to go in the future, and divided by the time discount rates. The risk-free rate is also going to be very easy. The risk-free rate in this economy is also just going to be raw, and then you can price easily a futures contract between, let's say, 0 and 1. And when you have that, you have like the traditional parity equation that holds, where the price of the future is going to be the initial price of the risky asset, and then times 1 plus the interest rates. Okay, so that's like very, very basic. That's the benchmark. Let's try to think about what's going on in a DeFi lending world in this case. So if you have a DeFi lending, basically if you want to self-finance a position, you have two ways of doing that. You want self-finance an exposure to Ethereum, let's say. You can do that in two different ways. First, you can just get some leverage. So you can buy ETH, you can borrow DAI against ETH that you put as collateral. And if you do that, the payoffs that you're going to get is going to be how much, what's the price in the second period, or the first period, time 1, minus how much you put as money, plus how much it costs to finance the position, at times how much it costs to finance the position, which here is going to be that you have to pay 1 plus R DAI, but then you get the Ethereum, which you can then lend to somebody else. And the fact that you lend it, you're still going to keep the position that you want. So you get an additional bonus from the fact that you can lend the ETH in the platform. Or what you can do as well, you can just buy futures, and that's it in this case. So and then if you buy the futures, then the payout is going to be the difference between the price of the assets at time 1 minus how much you paid the futures at time 0. Okay, so because the two strategies have to be equivalent, then we need to have this parity holding where like the payouts have to be equal. So we know that the price of the futures should be equal to the price at initial time times this ratio of interest rates, which is exactly what CIP is in international finance. The only thing is that here you only have one asset whose price is moving. That's the only difference, whereas otherwise you have possibly like movements in both directions. Okay, but so let's try to compare the two things, because at the end of the day here it's also like one risky asset, one risk-free asset. So what's the difference between my benchmark model and what comes out of just doing this CIP type of analysis? So in the DeFi lending platform, now we are dividing by 1 plus the interest rate on ETH, whereas in the benchmark you don't have that. So benchmark basically, another way of saying that is the benchmark is telling us that the interest rate on ETH should be 0. And here I'm wondering why would be the friction that would make the interest rate on ETH being higher than 0? Well, I think it's because the nature of the two interest rates are actually very different. So the interest rate on DAI, that's simply in the model, simply the interest rate you get on the risk-free rate. That's the return you get on that particular asset. But when you think about it, the interest rate on ETH, it's not the return you get on ETH. The return you get on ETH is going to be just a cash flow, if you get some cash flow, or just like the change in price. That's going to be the return. So it's a long-lived asset, ETH. Plus, now in this particular case, you also get this bonus in interest rates, which is really here, there's some form of extra compensation or just a convenience here that you get on top of the normal return. Like in other words, like in treasuries markets, this would be called, if you pledge that as in the repo markets, that's going to be called a specialness. So you get some additional return because there is some form of a scarcity of that asset in the first place, because people want to short the asset, and because people want to short the asset, they are willing to pay in order to access the asset. But I think it's probably worth spending a bit more time thinking about what should be the condition for supply in this asset. Here in this case, it's like it's an arbitrage. Everyone should, like in a rational model, everyone should supply the ETH into the platform. If there is no risk associated, you just get an extra bonus. So I'm wondering exactly what in the model is making the supply curve being upward. Here, if you should have like a perfectly rational model, there shouldn't be any constraint here. But so what's going on in the model is actually a combination of two things. Is because you have this PLF function. The PLF function is actually going to create this upward sloping curve in the first place. So that's what's creating the scarcity, and the scarcity is what's creating the fact that you have this interest rate here. But I think it's worth keeping in mind that these two things are very different in nature. Okay, so let me go to to DAI. How should we think about the interest rate on DAI then, on the stablecoin, on this risk-free asset? So in the benchmark, the interest rate on DAI should be equal to just the time discount rate. Anything different than that would be an arbitrage. Well, in reality, there might actually be some other things that are going to drive the price. So first, there could be some form of segmentation between the real world, or like the traditional finance and what's there. So that's not on the slide, but that's we could start from there. I'll wrap up. And then, but what you could also have that you have like many frictions. First of all, there is a risk of depegging, and the risk of depegging has to be taken into account. So there's going to be a risk premium on that interest rate. But now on top of that, on top of the risk of depegging of DAI, you also have a risk that the DeFi platforms gets some like very sharp liquidity event, and then you make some losses in that liquidity event because they don't liquidate fast enough, something like that. So you have an additional risk premium here. And then the last one is that we also know that when the utilization rate goes to 1, then you cannot withdraw. And so again, that's an additional risk that should be taken into account. So I think if you want to go like an empirical analysis of this, it would be worth taking into consideration these three potential sources of movements. And that brings me to my conclusion slide. So I think it's a great paper. I really learned a lot about, like a lot of food for thought. I think the paper would just benefit from like streamlining the model a bit more to connect the assumptions to the results a bit better. And then, yeah, I think it's really worth making the point that here we are facing some form of specialness, like a convenience yield or something like that, which is similar to what we see in the stock market, treasuries market, and things like that. And then, again, like also better connect stablecoin lending to the underlying risks that are behind. But overall, it's a great paper. Thank you.
Thank you, Quentin. Nash, would you?
Thank you, Quentin. Yeah, so I think in general, some of the stuff on the stablecoin sort of risk premia, so that could play a role in kind of this lending rates sort of being different from ETH rates. So it's not just about kind of futures premia and speculative trading. So I do agree. And I think to the extent that there are these kind of depegging risk and liquidation risk, that would indeed explain why it's not perfectly integrated, right? So if these additional sources of risk would kind of break the link between interest rate differences and futures premia. And yeah, I think I need to think more about kind of the difference between our CIP condition and the one with just the DAI rate. I think my understanding is that if you just look at the forward rate being a function of the DAI rate, I think that makes sense if you only can do long positions. So I just need to think about whether, because I think the CIP condition allows, it sort of comes from the fact that you can do both long and short positions as well. So I think, but we can kind of look at, I do agree we should have these sort of benchmark models to compare our results with. And I think the CIP conditions kind of our ideal benchmark to compare to. And then our idea is to kind of say, okay, why we don't have the benchmark being satisfied, like why we have kind of deviations from the benchmark, and that's our kind of weak integration. Yeah, okay.
Question. So I have a question about the gas fees. Maybe you can try to check what's happening in like L2 solutions, because I think some of them offer lending derivatives. So maybe there you can find more efficiency, like what you think that is the problem in Ethereum.
Yeah, so this part is still a bit of work in progress. So I think to start off, we looked at gas fees. I think gas fees, in some sense, if you can potentially scale. So if you have a really, really large transaction, you could scale enough so that gas fees become irrelevant. But the problem when that happens is you could have price impact, like kind of slippage cost, and then that plays a role. So we are trying to kind of think more about this transaction cost if we try to scale, then we start facing more price impact, and that would be the limiting factor. So that's kind of something, it's still a bit of work in progress. So we don't want, by no means do we want to say gas fees is the only factor to be taken into account. So price impact's quite important as well.
So these interest rates are like very volatile. So I was a little surprised by the time series graph you had. It's pretty stable.
Yeah,
So you probably smoothed it,
Yes,
or like
yes,
you
we
sample at an annual frequency or something. But because these are like super volatile, so like from one block, it can go from like 90% in one block to like 10% in the other block. So I'm just a little worried that you can interpret this as like a arbitrageable opportunity, just because how widely these interest rate fluctuates at a very high frequency.
yes.
Because of that, I'm also a little worried, like how you can interpret the CIP as sort of like as an arbitrage phenomenon. Instead, like a simpler model that I have in mind is just that the futures market is pretty stable. You have these wild fluctuations of interest rate and behaviors on compound and Aave, and then you just have this mechanical sort of relationship between borrowing and lending and interest rate, just sort of reflecting that particular market.
Yeah, so again, this is a point that I couldn't spend much time on, but yeah, there's interest rate risk. And so I think it's very important to note that there's no actual kind of fixed rate maturities, at least in the protocol we study, compound. And so you're going to have interest rate risk over like duration of a CIP trade. And so that's why we focused on perpetual futures, because even though there's no specific expiry, you've got this natural kind of funding rate that is paid every 8 hours. But I agree that if you were to take a 1 month futures contract and look at 1 month CIP, then there's a significant amount of interest rate risk there. And there are some kind of concurrent papers in this literature where they find no evidence that futures premia and interest rates are related for 1 month futures contracts. So that's something we can also look at, but it makes sense that interest rate risk starts playing a much bigger role once you look at longer maturity contracts.
So you alluded to the fact that there's also the on-chain, off-chain friction, and there might be, like FTX was one of the biggest off-chain perp exchanges, and we know what happened to their users. So I'd be curious, someone else alluded to this too, we now have on-chain perps that are starting to take off in volume, like DYDX and GMX. Have you looked at any of those numbers to see if there's a difference?
No, we just use Binance perpetual futures over our sample. We can look at other futures contracts as well. I think in general, we obviously focus on ETH Tether. We would like to sort of say that it's a more kind of general result, that it would apply to other pairs as well, but we just focus on ETH Tether because that was the most liquid, ETH Tether perpetual futures on Binance because that was just the most liquid one.
Okay, great. We made up some time. Alfred?
Okay.
Great.
Thanks so much to the organizers for having me. It's a great pleasure to be here and talk about Battle of the Bots. So this is joint work with Christine Pallur. So as we learned yesterday from Ari's talk, blockchain settlement is far from trivial. And I don't really need to motivate this here in this audience, but there was this Economist article that said in 2021, the settlement volume on Ethereum was the same size as the settlement on the Visa system. So this is important to understand why, how settlement works and what is efficient and what is inefficient. So in a blockchain system, the way transactions get normally settled is that you submit them to a peer-to-peer network. Transactions end up in this mempool. And everybody who runs a node can take a peek inside that mempool and see what transactions are waiting there to be confirmed. And the miners can then go and choose a subset of these transactions that are waiting, and they have total discretion which transactions to take, and they put them in a block. So that creates obvious problems, this system. So there could be, as we saw yesterday, potential problems with front running. So we consider a broader set of trading opportunities that arise because of these transactions that we see in the mempool. and we just loosely call those arbitrage opportunities. So this could be front running, this could be back running, this could be other things that I'll talk about in a second. So these arbitrage opportunities need to be found, so you have to be pretty quick. So you see the mempool, you have 8 seconds, you need to understand what is the state of prices on all the dexes, what can I do, what trades could I do to make some money. And so this is a very hard problem computationally. You have to be really quick, you have to take some heuristics. So you have to spend some effort to finding these arbitrage opportunities, but there are people who try to do that. So, of course, as these people find these arbitrage opportunities, other people could potentially free ride on these findings and say, hey, that's a really good idea. Why don't I do that? And so these arbitrage opportunities could be screened and these traders could be expropriated. So the order of execution, as we saw yesterday, as well, obviously matters. And so if I want to do a sandwich attack and front run a buy order, so then it's obviously very important that I execute before the victim and buy before the victim and sell after the victim. So I have to think about carefully how do I structure this. So, and even if the screener finds out that I'm trying to do an arbitrage trade, the miner is the ultimate authority, so the miner can then pick up the idea and execute it for themselves. And so this creates this minor extractable or maximum extractable value that we have. So there's this very interesting article about Ethereum is a dark forest, where they describe about some white hackers who found a weakness in some code and try to do the right thing, take the money out and give it back to the rightful owners. And they set up a very elaborate scheme with 2 smart contracts that one activates the other one so that their intentions are not very obvious. And they get screened and the money is gone. So very interesting example of how this works. So what do we want to do? We want to look at how does the screening and the fee structure in general affect the finding of these arbitrage opportunities. We want to look at who should be the screener, should this be the miner, should this be somebody else, and we find that optimally this is done by the miner. We also look at a private market for settlement, as we see them in flash bots and things like that, and we want to understand how does this impact fees for the ordinary users. So if the miners now can get some extra MEV revenue, that will change the way they set fees for ordinary users. So we want to look at that, and we will find that ordinary users can be better off with a private settlement market, such as flash bots. We have an empirical part too, so we find that more than half of the blocks are affected by this, and that the miners in total collect about $2.3 million a day from it. So before we start with kind of these arbitrage opportunities, I want to, from our perspective, not all the MEV is bad. Very often when you hear about MEV, people think, oh, this is a horrible thing, we should try to prevent this. But actually, MEV can have some positive things. Think about price differences on 2 AMMs, Uniswap, SushiSwap. That's totally inefficient from a financial perspective. You want to have price efficiency, have the same prices at multiple trading venues, so we need arbitrageurs to fix these short-term problems and balance out these AMMs, so this is a good thing, in our opinion. Think about collateral, under-collateralized loan on a platform like Aave or Compound. These loans need to be liquidated. That's an important part of the system. These are profitable trading opportunities for these liquidators. They have to be found. And so this also generates positive value. A little bit more contentious is probably these exploits that we see on the blockchain. But from a system perspective, you could also argue that if somebody writes bad code, they get exploited, the money gets stolen. But it's not really, it's just keeping the system clean. It's the equivalent of the SEC slapping a fine on some firm that behaves badly. And so, in a sense, that's kind of a free market punishment for people who write poor code. Now, some of these arbitrage opportunities are clearly inefficient, and so that would be the front-running attack, the sandwich attack that you heard about yesterday from RE. So ultimately, it's an empirical question of do we see more good activity or bad activity, and we want to address that too. So I don't want to go through the math. We have a model, and I want to present you the key trade-offs. So we have 4 types of users. So agents in our model. So the first ones are just naive users. So Alice wants to send some tokens to Bob. They have some private value for these transactions that are uniformly distributed over an interval, and they pay a fee to settle their transaction. The fee gets set by the miner. A second type of agents are arbitrageurs who could find these potential trading opportunities. So they have to invest some effort to find these trades in this 8 seconds that they have. And so there's some costly effort, and then they can find this arbitrage opportunity and submit it to the main pool or to the private market. Then the screeners are there who look at to find these arbitrageur transactions. If they go through the mempool, pick them out and take advantage of them and front run the arbitrageur. Again, they have to invest some costly effort in finding these arbitrageurs trades in the mempool and then see whether they can expropriate them or not. So in our model, the screening can be done by independent screeners or by the miner, and we want to see what is better from a welfare perspective. And finally, we have the miners. So in our setting, it's a profit maximizing monopolist miner. The miner charges a fee for a transaction that goes through the mempool, and in our model, there's kind of 2 transactions per block that can be processed. We first look at what would a social planner do. The social planner has to understand is, first of all, is this arbitrage socially desirable or not? And depending on that, the arbitrageur kind of chooses an optimal effort level for the arbitrageur to find these arbitrage opportunities, and the arbitrageur comes up with some kind of arbitrage trading. The social planner would include all the users' transactions because they generate positive welfare. So the fee in the blockchain would be 0, so that everybody is included and every ordinary user can submit their transaction. And finally, in the first best model, we would not have any screening because screening is just a transfer, and that does not really create any social value. So let's first look at a setting where everything has to go through a public mempool where there's no private market. So how will this work? So the arbitrageur's problem is to set an effort level to find the trade. The arbitrageur understands that he has to pay a fee that's set by the miner, and the arbitrageur also understands that he might get screened from the screener. So what does the screener do? The screener sets the optimal probability to find the arbitrageur's trades, so she has to figure out how in equilibrium the fee level will affect the arbitrageur's incentive to find something, and then set the optimal screening effort. The miner wants to maximize fees, and so the miner also understands that higher fees then changes all the incentives from the arbitrageur and the screener to participate in this game. So let me show you one picture. So this is the profit for the miner from the different sources. So start with the green line, that's the profit from the ordinary users. And since the miner is a monopolist, we have the typical graph here. So obviously, as the miner sets a higher fee, as we move to the right in this graph, then the fee revenue for the miner increases. But if the fee is too high, then all these low-value users drop out of the market. They don't participate, and so the fee starts getting down. So what is on top of those fees, the miner can also get the fees from the screener and the arbitrageur, and that looks like a linear graph. It's not totally linear, but it's upward sloping because these arbitrageurs really are very keen. They found a very profitable opportunity, so they're willing to pay pretty much any fee that the miner charges them. So what you see then is that the maximum fee that the miner charges is actually pretty high. And so from a welfare perspective, this is bad because a lot of the ordinary users are priced out of the market. So the peak of the blue line is where the optimal fee will be in that equilibrium that the miner charges. So what is the outcome? In the public market, the fees are high. Many users are excluded from the market. So this is not going to work well. It's better if the miner is the screener, because then the miner at least gets some screening revenue, and then the miner uses that to cross-subsidize or lowers the fee a little bit so that the ordinary users can participate. So next we want to consider the private market. So the flash bots came up in 2020, and they thought, well, this is inefficient for all the reasons that Ari pointed out yesterday, that we have these races and bot races. So there's a private market. You can contract directly, more or less, with the miner, and you say, I want to do this arbitrage, and I pay you so much if you settle my transaction, and the miner then accepts or rejects that offer. So what does the equilibrium look like? So we'll find again that optimally the screening is done by the miner, but how does the equilibrium work in this kind of setting? So what happens is that the miner screens the mempool to make sure that the arbitrageur does not go through the mempool. So this is just a deterrent. In equilibrium, the miner, all the arbitrageur transactions go to the private market, but the miner still has to screen the mempool just to make sure that the arbitrageur doesn't go there. So this way the miner can generate a segmented market, so you have all the ordinary users go through the mempool and the arbitrageur goes through the private market. So in this way it's good for the miner, because now the miner can price discriminate and charge the arbitrageur a high fee in the private market, and then the ordinary users a lower fee in the public market by creating this separated market. So this is good for the users, because now the users can potentially pay a lower fee. So MEVs actually and these flashbots type of interfaces actually generate welfare, because now for the ordinary users it's easier to participate. So we have some kind of cross-subsidy from the MEV bots to the ordinary users as they pay a lower fee. So here's one kind of pictures on the left-hand side to illustrate the segmented market. You see the fee that the miner charges in the private market, which is the red line, and in the public market for the ordinary users, which is the green line. And this is a function of the probability that the arbitrageur is active, which we can think about as a function of the potential arbitrage opportunities that are out there that can be found. So what we see is clearly that there is a separation between those two markets, and they pay a very high fee in the private market and a pretty low fee in the public market. So there's some sense of cross-subsidization. So on the right graph, you see the fee in the public market and the three equilibria. The blue one is when the miner is not a screener. The orange one is when the miner is the screener, but everything goes to the mempool. And the green line is with the introduction of flashbots when you have a private market interface. And we see that the fee for the ordinary users goes down and is lower when this private market is present. So what is the summary in the existence of these private markets? So we have lower fees and higher volume from ordinary users because we have this cross-subsidization effect. We have more welfare that's being created for the ordinary users because more ordinary users participate in the market. And there's also less congestion on the blockchain because the screeners are gone and all the traffic of the arbitrageurs goes through this private market interface. So in a way, the goals of flashbots was achieved in that sense. So we do have a little empirical part that I'm still working on a lot. So this is very early stage. So we have blockchain data from our own archive node and downloaded some data from the Flashbots interface. So we have data about 8 million bundles that were submitted. This is certainly a lower bound on MEV activity. Why? Because there's other private markets that we don't capture. The users might contract directly with miners and not go through Flashbots or somebody else. And there's some mempool transactions that might be screened, and we don't capture those. So this is clearly a lower bound on what we could potentially see. So we have some evidence. So first evidence is how are transactions ordered in these blocks. And usually the user set these gas fees, and what we would expect is the highest fee comes first in the block, but this is not always the case. So here's block 6,000,003, and you see how our transactions ordered based on the gas price. And what we see is that the first, after transaction 15, it works as it should. High gas fee transactions are first, and the lower fee transactions are towards the end of the block. But we do see that these first 15 transactions pay a fee of 0 and are still at the front of the block. So how is this possible? This is because the fees paid in a different way in these transactions. They are paid through what's called an internal transfer. They're not paid as a typical fee. So these are transactions that come through the Flashbots interface, most likely. So we then look at how many blocks have this unusual ordering of transactions, and we find that there's quite a few. So there's a little dip here when the merge happened, because probably everybody was holding back and said, let's see how this merge goes, and let's wait how this works out. But we do see that a large fraction of the blocks on chain have this unusual ordering of transactions. So we what's also interesting is that MEV gas was introduced in November 2020, but we see that even before that, there was quite some activity, as it seems, in these private markets that reordered transactions. Okay, so how do, when we look at fee payments in these private markets, it's a little bit different. Because typically in an Ethereum transaction, you can attach a fee to your transaction, and that fee then goes to the miner when the transaction gets included in the block, and the fee is a compensation for the computational effort that the miner has. But the problem with this model is that the fee also is due even if your transaction fails. So that's bad for an arbitrageur. Suppose you want to find an arbitrageur transaction and you want to trade, and that you submit your transaction, but by the time your transaction executes, the arbitrage opportunity is gone, then you still have to pay the fee. So the way around this in this Flashbots interface is that you pay with what's called an internal transaction. So as part of your code execution, where you execute the arbitrage opportunity, you initiate a second Ethereum transaction that pays the fee directly to the miner's wallet. So these internal transactions are harder to get. Not many data providers have them, so we get them by replaying the trace debug logs in our Ethereum archive node. And so this is how you can get a hold of these. So this is why these transactions show up as 0 fee transactions in the block, because they don't pay an official fee, they pay these internal transactions. So I want to show you a little bit about how much of this fee revenue comes from, miner revenue comes from the MEV transactions. So here we mostly focus on the Flashbots data. So as we collect more data, this might change. So we have about 15% of the miner revenue that comes from MEV transactions. And finally, we want to say something about our empirical questions about good versus bad activity. So bad activity, the front-running example would be a pattern where you see a bot trading, the victim trading, and then the bot trading. And good arbitrage activity would be like one transaction, say I want to liquidate an under-collateralized loan, that's one thing. Or if I do a back-running transaction, then it would be a trader and I do the back-running, so it would be two transactions. So if you look at good bots versus bad bots, so the bad bots are blue and the good bots are orange. And we can see that over time there's more good bot activity than bad bot activity in terms of fees paid to miners. And we have about $2.3 million MEV paid per day on average. So sorry, my time is up. I want to skip the summary and just leave with the happy note that this is a crypto paper where I can end on a happy note in the end and say there's more good bot activity than bad bot activity, which is very unusual. And we think that MEV is not all that bad. MEV can generate value and can cross-subsidize ordinary users. Thank you.
Thank you all. Thank you, and thank you, Alfred and Christine. I'm going to sort of give a simplified view of one aspect of the model to make a point about the timing of it first. So here's the, who's who in the cast. The arbitrager is the actor who locates the arbitrage or potential arbitrage and submits to the miner a group of transactions that, if they can all be executed jointly, will get a positive balance. The screener is searching the mempools to front-run the arbitrage trades, good or bad, and the miner validates everything. And in order for there to be some slack in the system, some source of value that's going to be there no matter what, we have these private value traders, what in often microstructure models we call noise traders. So in the simplified game, the day starts with a couple of these private value, actually in this model, one private value trader being drawn, and then with probability lambda, an arbitrager arrives. Now, this arbitrager is not all set and ready to go. This arbitrager has to expend some effort. Even if they're drawn, they have to expend some effort to possibly uncover an arbitrage. If they do, that's great for them. We are at the sort of the topmost branch here, and everything goes right to the miner. Now, what happens to the private value traders in that case? They get displaced, all right? So one cost of the arbitrage is that they do displace people who would have welfare gains from trade. But the probability of finding one of these arbitrages, the probability depends on the arbitrager's effort, and that effort has a cost, the search cost. And a very important aspect of the analysis here is the optimization from the viewpoint of the social planner. And we have components in this total payoff to society. Some of the components come from the private value traders, and some come from the arbitrageurs, and we see that these payoffs are probability weighted. There are lambdas there, there's EA, the probability of an arbitrage. But the cost of doing that effort, that search, doesn't have any probabilities in front of it. It is unconditional, which means potential arbitrageurs have to commit to search at the beginning of the day. And in this model, there's only one potential arbitrageur. And if you think how this is going to play out in practice, we probably have many potential arbitrageurs. They have to decide on their search strategy at the beginning of the day. And given that there are multiple potential arbitrageurs, there's going to be some redundancy, replication of costly search effort to find these arbitrages. The outcome's going to be winner take all. And that will multiply, all right, the incidence of these search costs. Now, okay, isn't this just like what we have in traditional finance? Think about traditional finance arbitrages, some of the simple ones. A crossed market, put-call parity, forward spot parity like we saw in the last paper. The search costs here are pretty low. They are all based on a very small set of publicly available prices. It's not like these DeFi arbitrages, which are going to involve search over a very large number of contracts. So in TradFi, yeah, we probably have some duplication of effort, but we don't worry about it as much because the cost is very low. Now, why doesn't everybody arbitrage? Well, there are limits to it that make some people better positioned than others. Not everybody can implement them at the same cost, but there's also risk to most TradFi arbitrages, because unlike the DeFi arbitrages, we can't condition the whole package on execution guaranteed. All right, so if we're doing a cross-market arbitrage, we might get one side or one leg of our arbitrage executed and the other not. So there's risk there. And on that score, I think the ability to condition, very nice feature of DeFi. Now, the arbitrages in this paper and in most of DeFi, they're what I'd consider pure arbitrage. They're instantaneous, risk-free, zero net outlay, and positive profits. Now, for a number of reasons in real-world TradFi markets, these kinds of pure arbitrages don't exist. So often, the terminology will reflect this. Quasi-arbitrages, risk arbitrage, which might strike you as a contradiction in terms, but even does an arbitrage have to have positive profit? Well, not always, if one part of it is going to have a private value. I think there might be social costs from redundant effort in this search. And now we're going to bring in the screener here. And they search the public mempool. And if they find a proposed arbitrage, they can front run it. They can appropriate the entire value. Both screening is kind of like arbitrage in that people who practice screening will say, I'm making the market more efficient, but it's really front running. And from a TradFi perspective, it's not an enhancement of efficiency. So with the screener, they get added as a final step here with their own search costs. And just like with the arbitrageurs, they sort of have to pre-commit to what they're going to be doing at the start of the day. And there's going to be duplicative effort here as well. So the solution that we seem to be aiming toward here is a private mempool where the arbitrager can submit arbitrage trades that won't be publicly visible and can't be screened. Now, the arrangements for this can be off-chain, and they can be very deeply hidden. And the point I'd make, we encounter these things in traditional finance markets as well, and they're solved through side payments. But these side payments and these arrangements are very opaque, and they are a perennial source of problems for market users and regulators. Payment for order flow, soft dollars. I started this week by attending a forum on payment for order flow. I attended my first sort of debate panel for payment for order flow like around 1993. All right, this is a perennial problem with these side payments. They're not a solution. Now, if you think about what a screener does, they, in a sense, can violate time priority, rearranging the sequencing of events. I would not tell you that this is unheard of in traditional finance. Many markets, dealer markets, have what's called a last look dealer's option. And the way it works is the dealer posts the quote, bidding 100, asking 101. A trader says, good, take them. I'll buy at 101. And the dealer then says, not so fast. All right? Now, the dealer is screening for customers or strategies that the dealer thinks are unfair. Well, why doesn't the dealer expropriate all trades at which they might lose money? The answer is reputation, right? Lack of anonymity can restore an equilibrium, really just like we saw in the first paper today. I'd point out current last look windows are short, about 100 milliseconds. Now, the last thing I want to touch on here are these unconventional orderings in the blocks. I found these fascinating, and I want to point out an interesting aspect of this one, the block that Albert looked at. So right here, that's the part that Albert was focusing on. I'm going to focus on another part of this block, and it has to do with clustering. And clustering is a psychological thing. And it refers to the tendency of all kinds of trade prices, limit order prices, stop trigger prices to congregate on so-called natural multiples of, the price grid. So Ari Jules yesterday, when he was using off the top of his head an example of a back and forth negotiation, it didn't go 17, 23, 32. It went 10, 20, 30, 40, all right? Now, how do you find it in an auction? And Alfred correctly said, this is an auction. Well, you look for these flat portions, okay, so there's a big flat segment at 20, there's another flat segment at 40, another at 50, and going in the other direction, one at 10. Now, when I run trading games in class, I see the clustering in the early rounds. Then what happens? A few people realize that, hey, I'm bidding 20, but if I were just to up that to 21, I'd go to the head of the queue. And as that realization enters the market, the auction takes on sort of a different quality, and you start to see these clusterings break down. And I just find it interesting that we find this in one of the most modern state-of-the-art markets that we have. And let me leave it there. Thank you.
Thank you, George. And thank you very much for your kind discussion.
Okay, any questions? Please.
So I have a question about the bad arbitrage. So do you think that they are indeed bad? Because I think, like, if you think about Robinhood, so the idea is that they use the data, they give you like to do transaction for free, and they kind of front run you. But it's kind of, instead of taking transaction cost. So same like the idea yesterday, the solution to kill the front running attack and the sandwich attack is to pay more kind of gas fees to the miners. So
I think if you want to really prevent front running and you have a large order, then you could yourself go through flash pods, right? So if you don't want to be front run. But we do see that the bad bots are decreasing fast. So they were big, but now they're pretty insignificant. And I personally think this is two reasons for that. First, there is technical innovations such as 1inch. Their liquidity pools are front running proof. And so that is one way. And the other thing is that probably these user interfaces that set the maximum slippage amount got smarter. And so what a lot of people don't realize is that in this front running, in any Uniswap order, you have a limit order, right? And so you have set a maximum slippage. And if you're more sophisticated in setting better maximum slippage amounts, then front running becomes unprofitable because you have to pay the gas fee. And for small trades, or if you set a tight slippage, then this is unprofitable. So I think it became less of a problem over time. Maybe at the beginning when people were naive in setting bad orders on Uniswap, then that's just more of a problem.
So again, about this bad things, we can assume that sometime in the future, somebody will come up with something else we don't like. And the question is, how easy it is to hide it from screening, hiding it behind some sophisticated smart contract that you need to go through all the steps to understand what's going on. And even if you don't want to fully hide it, you just want to offer plausible deniability for the verifier, so he can be bribed to say, oh, I thought it's just a regular transaction, who would have known that this happened, and then they can split the price between them. And then if we go into this, Ethereum, for example, has ways to punish validators for behaviors that we do not approve inside of the protocol. Do you think that this kinds of means will need to be used in this setting?
So these are a bunch of good questions. So I think you can always plausibly deny anything in crypto. It is pretty hard to hide anything. So if you read this very old article, 2020 article on the dark forest, they went through a lot of great effort to hide their intentions, and they still got screened. So I think it's pretty hard to hide. And should we use Ethereum as a punishment, validator punishment? I don't know. I think the more creative approach is to come up with a smart idea to overcome this problem. And we see that in a free system, solutions like 1 inch came up that prevent front running. So I think there will be times when perhaps somebody comes up with a bad idea, but eventually people will come up with good ideas to prevent the bad actors from doing their thing. So I think there is private sector solutions for these problems.
So if we consider miners as screeners, can we also consider miners as screeners and also as the arbitrageurs at the same time?
Yes, we can think about all of these at the same time, and so that is true. They could take 3 roles, even though there's probably some benefit of specialization. So this finding these arbitrage opportunities is not easy. It's really a computationally very hard problem, and so I don't think that you're necessarily good at everything. So I don't see if that is the optimal outcome, but it could potentially be an outcome, yes.
Okay, I think it's about lunchtime. I thank you all for being here. Let's all thank our speakers.